Right. So I did say that financial statement analysis actually is one of the broad, it's actually a course. You do this as a course to analyze the financial statements. Those
Excuse
that
me,
are
sir.
Ma.
Kindly zoom a bit.
Okay. I zoom more than this.
This is okay now.
Okay. Okay, thank you. Just a minute. Just a minute, just a minute. Oh yeah. Okay. All right. So I was just saying that with financial statement analysis, number one, it has what the 5 pillars. Number one, we test the liquidity of a company, the profitability of a company. We test the efficiency of a company, like how efficient the company is, or how efficiently the managers are handling the resources. We also test how geared the company is. It's called gearing. So that is to measure how much debt the company has. Then we also measure how risky, okay, risky of the company, how much risk is in that firm. That's what we study. So these are the 5 pillars of financial statement analysis. So you have to pay attention and follow. So there are ratios, okay, that we're going to discuss. And these ratios, they help us to measure how profitable the company is. We use the ratios. How much liquid is in the company, how efficient, how geared, and how risky it is. We'll be calculating some ratios. So please pay particular attention to that. Okay. We can start with the, let me talk about, let's start with the profitability and returns ratios. Okay. We are starting with the profitability and returns ratios. So with the profitability and the returns ratios, the first one that we have is the ROCE, or the return on capital employed, right? ROCE is the return on capital employed. It is given as the profit before interest and the tax, okay? PBIT, the profit before interest and the tax divided by capital employed, all that multiplied by 100. It will come out as a percentage. It is called the return on capital employed. Okay. So now the return on the capital employed, what it does measure, actually, it measures how much return you get from each capital that you have employed. Like how much of return do you get when you invest your capital? How much your capital is giving you, right? That's what it does measure. So the principle is the higher the ROCE, even the better. Okay. So we are looking for the ROCE, or the return on capital employed, that is higher. Get to understand that these ratios on their own, they don't have meaning unless you compare them with the ratios of the other year, like you'll be given 2 years, like in your assignment, you're given 2 years, okay? So you calculate the ratio for this year, you also calculate the ratio for the other year. Then you compare, okay? Did the ratio increase or it reduced, right? If it reduced, why did it reduce? What could be some of the reasons as why it reduced? Okay, if it increased, what could have led to an increase? So ideally, this ROCE should increase, okay? We need a lot of return on capital employed. Is that clear?
Yes, sir.
Okay. So you can always ask questions, especially on this one. Ask questions, okay? Ask the questions. Yeah, so that is about the first ratio is called the returns on capital employed. You should understand on how to calculate it, because you'll be given the data from the financial statements. Let's have the return on equity is a second ratio that we're calculating, right? The return on what? On equity, okay? This one is calculated by profit after interest and tax. That is profit after interest and tax. Usually we abbreviate this as PAT, okay? Profit after interest and tax divided by shareholders' equity, okay? Equity multiplied by 100. It shall come out as the percentage. So what does the return on equity help us to measure? So you'll be given this, you can calculate like from that statement you're given, that statement you're given in the question. Just check where there is profit after tax, after interest and tax, you write it here. Over equity, you write times 100, that is a percentage. You compare it with the other year, since you are dealing with the years in your assignment. But sometimes you can compare these ratios with the other companies, right? Calculate your ratio in this company and you compare with that of the other company. Then you check, why are there differences? Is this one for this company higher or less than that one of the other company? Or at the same time, these ratios, you can compare them with the average in the industry, okay? You can find that in the industry, like where that business operates, there is some benchmark. We say maybe the return on equity for a normal company or acting in that industry should be maybe above 25%. That's a benchmark. So when we calculate for our returns on equity as a company, we find that our ROI is less than 25. Then we have to ask ourselves, why is the return on equity less than what the industry gives? If it is more than what the industry gives, again, we should ask yourself, why? What is it that we are doing better than what the other companies are doing? So we have that information is very, very necessary to us, okay? So basically, the ROI, or return on equity, it helps us to measure or to assess the company's ability to generate profits by leveraging the investments made by the company's shareholders, okay? So ROI usually indicates the quarter profit that is generated by each quarter of common shareholders' equity. That is what ROI measures, or the return on equity. So the formula is this one. The formula is very, very necessary. You need the formula. The formula, you should get it, and what the ratio means, what it communicates for you. It is a measure of profitability, okay? It measures the profitability, so it assesses the company's ability to generate the profits by what? By leveraging the investments that are made by the shareholders of that particular company. The third ratio that we look at is it is still in pronunciation ROI. This is called the return on investment, okay? the return on investment. The return on investment is basically net profit divided by the cost of investment, okay? The cost of investment multiplied by 100 as well. Net profit over the cost of investment multiplied by 100. Now, this one, it shows you the return from your investments, okay? It actually helps you to, it helps you to choose. Just a minute. It helps you to actually choose, okay, the best investment across the different investment options. Just like investment appraisals. So when you are given the different investment options, right? For you to choose which one is which, you need to calculate from those investments the return on each investment. It is basically the net profit divided by the cost of the investment multiplied by 100. That is what it communicates. And obviously, you can know with the truth that the higher the return on investment, even the better. You compare these with the return on investment for one investment to the other. So if it comes to the years, when it comes to the years, you can compare for this year and for the next year. That is what is actually there. So you compare. If it has reduced, then you have to be worried. Communicate, speak, write that it has reduced. And you can still dig practically what has made the return on investment decrease. Why has it decreased? That is very, very necessary. So that is what is there. That's about the return on investment. It's another ratio that we use to assess the profitability of a company. We also have got another ratio which is called the return on assets. Okay. Yeah, this one assesses the ability of a company to efficiently use its available assets to generate earnings. That is called the return on assets. Others pronounce it as ROIA. Okay. Return on assets. Okay. It assesses the ability of a company to effectively use the available assets to generate the earnings. Okay. Since you are comparing, actually, the higher the ROIA, the return on assets, even the better. To calculate for ROIA, or return on the assets, you have the profit before interest and the tax, PBIT, over total assets multiplied by 100. That will give you the return on asset. So I've talked about the return on capital employed, return on what? On investments, isn't it? We've talked about also the return on assets. Very, very important ratios. They give us, or they speak to us, they help us to measure the profitability of a company, how profitable the company is. There is another ratio that we call the asset turnover ratio. This one, actually, it does measure the ability of a company to generate sales revenue in relation to the size of the asset investment. So it does measure the company's ability to generate the sales revenue in relation to the size of the asset investment. That is the asset turnover. That is what it does, okay? So most of the times you find that companies invest in assets to improve the execution of their operations. Now, total assets turnover is actually a ratio that relates the amount of sales that are generated from every unit of an asset. We are looking at the sales. Among the sales that we have, how much of them have come from the assets? That is necessary, and you need that ratio, the asset turnover. So to find the asset turnover, you just say the sales divided by what? Capital employed. It is measured in terms of the times, okay? Sales over capital employed, not multiplied by 100. Then you say times I. So the company that has got the asset turnover about 3.75 times during the year, it simply means that that company made the sales revenue of about 150,000 and the total assets were equal to 40. Okay. So that is what is there. So capital employed shall be divided into sales, then you can have the asset turnover. Now, one of the most important now ratios that if you forget all these other ratios, you must never forget is the gross profit margin. This is very crucial. When you're testing, because what you're doing we are using the ratios that help us to test the profitability, okay? That's where we are. We're still talking about the profitability. The gross profit margin is one of the crucial. At least you need this one. If you've forgotten other, at least this one you must remember. It is a measure of a firm's profitability at a gross level, okay? It is usually expressed, as a percentage of the gross profit to the sales revenue of a company. The gross profit. To find the gross profit margin, you just say gross profit divided by net what? Sales times 100. That's how we find the gross profit margin. Okay. It is an amenable thing. One of the most interesting and applaudable thing, if we can have the gross profit margin that is big. Ideally, we need the profit margin that is big. Okay. We compare with the other company. I've told you now for your assignment, you have 2 years, right? You compare for this year and for next year. So gross profit over net sales times 100. Then you compare, did it increase or did it reduce? This one measures the profitability of the company. How much profit you generated from the sales, like did they sell the profit increase, the gross profit, of course, or it did reduce? You have the net profit margin as well. The net profit margin from the gross profit, you have the net profit. This one is net profit instead of gross profit. Use net profit over net what? Net sales times 100. This one is used to describe the company's ability to produce the profit and to consider the several scenarios such as an increase in expenses, which is deemed ineffective, all right? So you can consider, you see that in net profit, we also consider the expenses. But in gross profit, just from the knowledge that you have from accounting, in gross profit, we don't consider the expenses. But other net profits, we also consider the expenses, the impact of expenses. So when we have removed the expenses, whatever have remained is the net profit, okay? So we need the net profit, which is one of the most important profits that we need, the net profit over the net sales. Multiplied by 100, then you will have a net profit margin. This is very, very, very important. You need to know how to calculate the net profit margin as well. It has the same information. It communicates the profitability of a company. There is somebody saying, well, sir, are we going to manage to remember all that? Do not panic. Let's have the conversation. We even do an example. Then you will be well. You will be fine. Okay? Don't worry, you'll be fine. The operating profit margin as well communicates the same thing, but the profit, you use the profit before interest and tax over the net sales. And then you will be fine. Then now, we have talked about some of the key ratios that we can use to test the profitability of a company. The key ones that you must never forget is the gross profit margin, the net profit margin, the operating profit margin, the return on capital employed, and the return on assets. These five, whenever you're commenting on the profitability of the company, at least they have to be there. I gave you about close to 10 of them just to measure the profitability, how profitable the company is, right? These ratios. But at least, if you can forget all of them, at least remember these. You will be fine. You can still communicate something that is dependable. Having talked about the profitability of a company, is it necessary also to test the liquidity of a company? It is very, very necessary. We also have other ratios. I've talked about the ratios. I've said these ratios are grouped, right? Profitability ratios and liquidity ratios. Now, the word liquid, it means readily convertible into cash. So, and a firm's liquidity is its ability to convert its assets into cash so that it can meet all the demands for payments as they fall due. Something that is liquid in this context, don't start talking about liquid in science. Remember that liquid is something in science. Is it whatever? It's not that liquid you're talking about. The liquid we are talking about is, it means that something is readily convertible in cash in finance. That's what we mean. You can easily convert that, the easiness with which you can convert an asset into cash. You say that that asset is most liquid, is more liquid than the other. And the cash is the most liquid. So the ability of a company to convert its assets into cash to meet all the demands for payments as they fall due, that is the liquidity of a company. So you see that we need companies to be to have high liquidity. They should be liquid enough. We should have they should have the ability to convert these assets into cash so that they are able to meet the demands. Okay, they can pay for payments as they fall due. Because if the companies do not have enough liquid, then they are in danger of running insolvency or going into insolvency. That means the problem of not being able to meet their demands, like they are not able to pay for, not able to meet their obligations that they need, especially the short-term ones. So we need more cash. The first ratio under liquidity that helps us to test the liquidity of a company is called the current asset ratio. What does this do? This compares the assets which will become liquid within approximately 12 months, that is 1 year. It compares the assets, the short-term assets or the current assets with liabilities. Therefore, when calculating the current asset ratio, you say current assets divided by current liabilities. This is one of the ratios that you can never omit when you are analyzing the financial statements. The current ratio. Check where there are current assets. You know that current assets are coming from the balance sheet, isn't it? Go to the balance sheet, get the current assets, get the current liabilities from the balance sheet, put them here, and then comment how liquid the company is, okay? How much easiness the company has to convert their, their resources into cash. Their assets into cash. So most of the times it is amenable, it is something that is very, very recommendable for a company to have a quick or a current ratio of 2 to 1. Okay, 2 to 1. This simply means that when the current liabilities fall due, even 2 times, we have the capacity to pay for them, okay, to meet our current liabilities. So the current assets covering liabilities twice as much if all our current liabilities fall due at the same time. That's what 2 to 1 means, okay? So this is a recommended non-cap. It's a benchmark. 2 to 1 is better. 2 to 1 simply means the liabilities, current liabilities, go into assets. How many times? 2 times. Meaning our assets are more than what? The liabilities. We want a company to have more current assets as compared to the what? To the current liabilities. That is very, very okay. But if you can have a ratio of 1.5 to 1, it's still okay. Anything less than this, then you are in danger. If you can have a current ratio of maybe 0.23 to 1, that is very, very dangerous. Yeah, it means the company does not have liquid enough, which means maybe they just have a lot of fixed assets, right? These guys are most likely not to be able to meet their short-term obligations, such as maybe paying off salaries to workers, just those short-term obligations, okay? The quick asset or acid test ratio is one of the ratio that we use to test the liquidity of a company. It is called the quick asset ratio. With this one, you say current assets minus inventories divided by current liabilities, okay? So what you do, the way how different they are from the current ratio, it is different from the current ratio just by subtracting the inventories. From current assets, you have removed the inventories because the inventories are not liquid enough. Because inventories are less liquid. That's why we are removing them when you go to acid or quick asset ratio. Why should we remove the inventories? This is because the inventories take time to be converted into cash. You have to sell them, more people have to come buy, all that. So such assets, inventories, are not counted now as part of the current, the like quick assets. I mean, when we are calculating the quick asset ratio, we remove them. Once we subtract them and divide by current assets, what we shall have is a quick asset ratio. It has the same message, but the rule of thumb is a 1-to-1 ratio, which means if current assets, current liabilities can just enter into current assets minus inventory at once, it's still okay. Which means even if they can be equal, okay, it's still okay. Current assets equaling current liabilities. That is current assets after removing inventory, okay? Then we are still fine. So the benchmark is 1-to-1. Never have 0.90 or sorry, 0.7. Yeah? Never have 0.7 to 1. That is dangerous again. It means that the company is less liquid. They are not likely to meet their short-term obligations. Okay? So these two are the main ratios that we use to test the liquidity of a company. Okay, these are the two main ratios that we use to test the liquidity of a company. This time around, before I can comment on the efficient ratios, I call for any question. Is there any question?
Sir, I don't know. You just mentioned that never have 0 point something. So it should be
like a current
1 on
ratio.
1. Yes.
It should never be less than 1. Like it should not be maybe 0.7 to 1. It should be 1-to-1 for quick ratio. It should be 1-to-1. Then for the current ratio, it should be 2-to-1 or 1.5 to 1. it should be above 1.5 to 1. That's how you comment.
Okay.
So when you check, you analyze these ratios, say, no, we are in danger as a company. Okay, these are the ratios that you study in financial statement analysis. Another question? All right, we are good to go. We have the efficient ratios as well. Now you can pay attention here. This is very, very necessary. Just as I said, the efficient ratios. The efficient ratios help us to measure how the managers are running our company. Are they efficient in using the resources? Okay, those are the efficient ratios. They measure the ability of a company to use its assets to generate income, the efficient ratios. So under the efficient ratios, we have number one, the first ratio that we have. It is called the inventory turnover ratio. This is very important. The inventory turnover ratio. So the inventory turnover, the turnover is actually the period. Turnover period actually is an average length of time. That's what the turnover period means. Okay. Now, with the inventory or stock turnover ratio, it does measure to us on average how many times in a month or a year the inventory is turned over. You didn't get it. It shows, it speaks to us on average how many times in a month or a year that the inventory is turned over. So the higher the inventory turnover, the quicker the inventory is being turned over. So it helps us to check whether we have got too much money tied up in the inventory or not. Okay. So we do not need a lot of time. Okay. Of us holding the inventories, because inventory turnover ratio measures the number of times on average a company sells inventory during the period, and then also the average days to sell the inventory that represent the average number of days in which the company has inventory on hold. Okay, how long does it take for us from the time we make orders before we can sell the inventories? And the formula is given here. It is the cost of sales over average inventory, or the cost of goods sold over closing stock. That's a formula that you use. The units at the time, don't multiply by 100. No, it's times. Okay. So for example, if you find 3, the units that you put, you say times I, 3 times. 3 times
Sir, are you there? Rasa, are you there? Rasa.
I think he's logged out. He's been logged out.
This network for today, it has been kicking me out. And
He has said he's trying to log back in. Give him a few minutes.
all right.
Thank you.